All right, welcome everyone to this week's Value Investing Live. I'm pleased to welcome our guest, Keith Smith, who's a CFA and portfolio manager at the Bonhoeffer Fund. He brings 20 years of valuation experience to the fund and also serves as a director for Enterprise Diversified and as an advisor to Willow Oak Asset Management. As always, for those of you out in the audience, do please feel free to post those questions and comments. I see Jason jumping in there right at the get-go, as always, from the beginning. Thanks for joining us, Jason, for a brief moment. And for the rest of you out there, please feel free to post those questions and comments throughout. Keith does have access to them. He will be able to respond to them at any point in time, and we'll be keeping an eye on them. As always, we tend to keep those towards the end, but if there is a pertinent question that pops up, Keith is going to go ahead and address that in the moment. So please feel free to let those questions and comments flow throughout the presentation. Without anything further from me, thank you all for joining us today. I'll go ahead and hand things over to Keith, and we can jump into the presentation.
Hey, great, thanks. Appreciate being invited to give a discussion here. Today I'm going to be discussing some key aspects that I use in managing the fund that I think maybe some frameworks I think that'll be applicable more in general for overall investing. And I'm going to go through some specific examples to show how that's actually been used in the fund recently. So why don't we go ahead and start out? So the first piece here is okay. Oh, there we go. All right, got the disclaimer. And then, so to start out, the Bonhoeffer Fund is a global. Historically, the fund is focused on emerging markets value special situations. So we would find situations where the value of the company was significantly different than the currently traded price. And so what we've done is we've gone through the world. We found that we were sort of focused on emerging markets for a while there, and then we continue to have a very large emerging markets exposure, especially in countries that we feel comfortable with the overall trends of the governance in that country. But what happened is, so pre-pandemic, that was our exclusive focus. What's happened since then is during the pandemic, we've actually started to examine more market in transition situations where there's growth opportunities as a result of fragmented markets. And what we've looked at in those is we've looked at those markets through a franchise lens, and we've still been able to maintain our value discipline by basically looking at what companies would be worth going forward in terms of a number of years forward versus what they would, from a snapshot, would be worth today. So the key aspects of looking at companies this way is the components to increasing returns on capital. And there's two components. One is cash flow growth and lower and shared investment. So the return on capital is you've got the return, which is cash flow, and then the investment. And so those are the two aspects of it. And so what are the two components of cash flow growth? Revenue growth and margins. So we started out with a framework that's basically applicable to Bruce Greenwald in his current book, Value Investing 2. He basically looks at four or five major sort of areas to look for franchise firms, which are the type of firms we're trying to look for the long term in terms of investing in those firms at reasonable valuations. So some of the characteristics of those firms is they have high returns on capital equity, typically 15% plus. They're exclusive or oligopolistic franchises, and these franchises may be in a local market versus a national market. So examples of these things would be U.S. car dealers. Those are more local markets, and they have specific franchises in those local markets. Telecom and cable is another one where basically it's more of a local market. These companies also have cost. We also look for cost advantages, try to leverage off economies of scale and scope. One of the key things we look for is operational leverage, which basically allows, as the revenue of the firm grows, the margins will grow also. So if we can identify some fixed costs in the cost structures of the firm that can be spread over a larger customer base as the firm grows, it provides some really nice operational leverage opportunities. We also try to look for sort of revenue advantages, which are basically network economics or customer lock-in. So these are sort of the advantages a franchise firm have. Network economics, we're going to be talking about a telecom company, which you'll sort of see as the network gets bigger, the network becomes more useful. And specifically in telecom companies, you'll sort of see that as it gets bigger, there's more people on it, there's more interactions between people. There's also the aspect of sort of customer lock-in, which is really more associated with, you can really see that in software companies where in essence, you get locked into a specific piece of software and it's very difficult or the cost to change is very high. You could also see it in other areas, like maybe in some auto dealerships where in essence you have a service tail where basically you have constant interaction with the customer. The customer feels comfortable and therefore the customer can get somewhat locked in from that perspective. The last piece that we look for are markets that are slowly changing. If you have a market that's quickly changing, it adds a lot of additional complexity into looking at franchise firms. So the specific markets that we've looked at that slowly change are telecom, cable, which we'll go through a specific example in the presentation here. Retail is another one where it's slowly changing over time. Software, where you can get the lock in so that it's not going to change, and home building. So in terms of specific things that we're looking for, so those that we're looking for these franchise firms in these fragmented markets. Now, fragmented markets really provide an opportunity from multiple different ways of being able to actually as the firm grows in a fragmented market, it can take advantage of economies of scale versus its competitors. And so in looking at fragmented markets, it basically can provide long runways associated with the consolidation and the associated cost economies of scale. And these basically the interesting thing about these is you can actually get cash flow growth in excess of market growth. And we'll see that in an example of a company that we're going through today, which is basically Asbury. Even though same store sales and the overall auto market has been flat, Asbury has been able to have some pretty impressive growth over time, like low 20% EPS growth as a result of basically being able to consolidate certain markets and take advantage of economies of scale in those markets. And so the other advantage, if you look at these fragmented markets that are truly very fragmented, it allows this process to be repeated over and over and over again. And it basically can almost become something that's repeatable. And what's very interesting when you take a look at a lot of analyst estimates is in most cases, analyst estimates won't include acquisitions. But in a lot of these businesses, for example, when we go through the auto company we're going to be looking at, acquisition is a key part of what they do. And when that's a part of the actual business model of the company, and the analysts aren't putting it into their forecasts, what you'll see is constant surprises going forward in terms of earning a repeatable surprise factor for both revenues and earnings going forward. So it creates a long-term approach to basically a repeatable process from a long-term perspective where you can constantly have the company re-rated or increasing in value as both the revenue increases over time and the cost synergies take effect as the firm grows over time. The other thing about these sort of markets is a number of them, and so we can select across the best markets and geography. So some specific examples. You can take a look at a company like Ashtead and URI, which are basically these got equipment rental in the United States. They're the two largest competitors in the equipment rental market. They have a huge competitive advantage over the other players in the market, and it's a very fragmented market at this point. So what that really allows them to do on a local basis, if you can think about equipment rental, the more equipment that you have in a local market, the more efficiently you can rent it out to the various people that would be in that market. If you also have equipment in adjacent markets, you can shift the equipment between the adjacent markets versus, let's say, a smaller competitor in that market, where they're not going to have the quite economies of scale in that market. The other thing that these companies have done, specifically Ashtead, is they also have the ability to sell other types of equipment through an established infrastructure in the market. So they have a construction equipment leasing business, and let's say a market like DC. Then they can basically continue. They can distribute cleaning supplies through that same distribution channel and get highly incremental or profit as a result of that. So that's very similar to the Amazon kind of model, where you set up an infrastructure and then you just push more and more stuff through the infrastructure. So in these kind of situations, you'll sort of see this sort of happens here from that perspective. Another one is the second one is like automobile distribution. So these are like car dealers. And Cambria and Motorpoint in the UK. Again, you'll have these local economies of scale where it's a very local market, local advertising, local being able to manage the business, other types of local costs you can spread across multiple dealerships. mean, the interesting thing about this thing also is that you can actually, there's actually automobile distribution, there's been some vertical integration also. So one of the key things, aspects of these types of fragmented markets, Keith Rabios, who's a guy that founded PayPal, one of the strategies that he really thinks has been effective in high tech type startups has been vertical integration into fragmented markets. And what I try to really look for are these kind of businesses that maybe are not internet businesses that are necessarily going to be priced relatively high now, but maybe bricks and mortar businesses that are doing something similar. Automobile dealerships are very similar. They vertically integrate, so you not only have them selling new cars, they sell used cars. They get used cars that are coming off of lease as another source of getting used cars, in addition to the trade-in you do. They do services, parts, and finance. So they've vertically integrated across a number of different services while beginning with just the initial car sale. Another example of that is sort of home decor. A company called At Home is providing that type of a situation where they're rolling up stores. You have a store concept in a specific region, and then what you can do is just repeat that concept over and over again. Now, interesting company like At Home is they feel that they can double their store count over time. So if you can double your store count over time, it creates you have good unit economics. So another commonality across all these businesses is you really need to take a look at the unit economics. If the unit economics is really good, then you can repeat this over and over in different markets, and it really provides a sort of a snowball kind of effect in terms of these types of businesses. So that's an example. That's an example in retailing. And finally, an example would be in connectivity, which is Consolidated Communications. That's the example that we're going to take a look at in regards to that. But that's sorry about that. Let's see. There we go. Okay. So connectivity. So we're going to be taking a look at that in terms of Consolidated Communications and Frontier in the U.S. This is an interesting market in the fact that you have new players coming in that are pure play broadband providers, but both of these companies basically are legacy players that are rapidly expanding their broadband infrastructure. And so therefore, they provide some real interesting catch-up opportunities, especially associated with like cable companies. Because at this point, cable companies, their primary growth area and the primary focus is providing broadband. These companies, as they roll out their networks, have a real interesting opportunity along those lines. In addition to, if they can provide it with a very high NPS or customer service score, they can really do relatively well. And we'll get into specifics of that when we get into the consolidated example. So the other things that we're looking at, those are examples where we can examine the incumbents that are adopting the innovation. So for example, in broadband and telecom, they're adopting broadband, laying fiber optic networks so you can have very broadband connections to everybody. And it can enhance the growth. And this growth may not necessarily be reflected in the stock price. And we'll take a look at that. That's an example. The two examples we're going through today is that you had an innovation in both these markets. In Asbury, you had this internet sale of automobiles, the ability to sell automobiles online. And so that's created a huge growth opportunity. And Consolidated, again, you've had sort of the broadband piece. So in both these cases, you have sort of older line businesses with decent business models. But this enhancement or innovation has really created an additional opportunity that today's prices aren't reflected in those for those particular aspects of the business. So if we look at sort of the sources of high returns on invested capital, there's high cash flow return on sales, which is basically growth in cash flows, and you want to try and get modest outlays. So a lot of this would include like service businesses. So for example, if you look at auto dealerships, a lot of their costs are either service related, or if you're talking about financing inventory for a lot of their automobiles, a lot of it basically can be floor plan financing provided either by the OEM or some other third party. So they themselves are not incurring, they don't have to basically they're buying the automobiles on credit at a reasonable interest rate. So that's an example of sort of having modest outlays in that particular business. The other key piece is to leverage off others' infrastructure in regards to trying to create modest investment outlays. And you see that that's an example, for example, in the auto the auto business that we just mentioned. They're leveraging off the OEM's financing ability and other things that the OEM will provide to these auto dealers. So the sources of cash flow growth are increased market demand, which in most of these businesses, the ones we're looking at today, the overall market's growing maybe at GDP. So it's growing at maybe 2 to 3%, and the stock prices reflect that. However, there's these additional factors that are really creating more growth than just a GDP type of growth businesses, and that's where the opportunity lies. And so for example, in each of these cases, they're getting increased local market share as a result of laying out these new technologies. In the case of Consolidated, and in the case of Asbury, it would basically be getting larger market share within the local market in terms of selling automobiles. The other thing that's important with retail and automobiles in particular are product turns. And how this really becomes important is that if you can turn a product faster, what that allows you to do is it allows you to basically get the same return on invested capital and charge and get that at a lower margin, so you're more competitive with other people in the market from a pricing perspective. So one of the key things we'll note about some of these businesses, especially the retail-oriented one, which in this case would be Asbury, is the high turns that they have. And that high turns provides them a lot of advantages, in addition to the economies of scale. The second piece we're talking about here is higher margins. So you get the turns, and then you get the higher margins in combination of that, where you get the economies of scale and scope. If you're turning things quicker, you've got a fixed cost infrastructure. You're spreading that fixed cost infrastructure across a larger number of sales. So you're getting economies of scope. You get economies of scale, let's say, in a local automobile market, where if you're focusing on that market, then you only need to be concerned about advertising in that local market. If you're spread across the country, then you have multiple markets, because in essence, in both these situations, these companies, there's really no national market. It's more of a combination of various local markets. And then we talked about economies of turns in terms of scale, in terms of how that really can help out quite a bit also. So get a little bit more detail into velocity. It's basically, I described it as sort of a multiplicative growth factor. So as we talked about before, you sell more products and customers per year than your competitors, you can spread the cost across more sales. You can offer savings to the customer, so the customer gets that as a customer surplus. Achieve higher sales growth and higher margins all at the same time. So trying to find these kind of situations is sort of like, it's a great combination if you can find it. So this is, for example, what Costco really does well in terms of a model. They basically are able to turn stuff very, very quickly, and therefore they're able to offer their members a lower price than anyone else. And this kind of thing can happen in other types of retail businesses. So, for example, we talked about At Home and Asbury, where you've got a retail part of the business. This is a key, in my opinion, really a key concept to take a look at. And then the velocity can become sustainable to the extent that you can retain existing customers and attract new customers. And that's a key aspect behind this. If you look at, one of the key things that a lot of retailers look at is, okay, what's the repeat amount that people are buying, tracking the customers with the technology today, you can really provide a lot more stickiness. And in the case of Asbury, they have services they can provide after the sale. A lot of the new cars typically have warranty. If you're leasing the car, you're going to be going back to them. So there's a lot of touch points that they can basically cause stickiness in their customer base, versus, let's say, other models that are used car only, which would be, let's say, called the Carvana or even CarMax, because they don't have as many sticky touch points as Asbury and some of the other incumbent auto dealers have. And then basically velocity can be measured as, one way you measure velocity is product or inventory turnover. Another way you can measure velocity is sort of recurring revenue or renewal rates in more software types of businesses. So let me go to a specific example of velocity in the auto retail space. That we'll go to a specific example later, but this provides an example. So one thing you can look at is relative velocity trends as a measure of recurring sales. So inventory tells you how fast the firm is matching customers and products and services. So, for example, if you in the UK, there's a company called Cambria. They have the highest customer velocity inventory turns of any UK auto dealer. One thing you notice about them is that they have a little video clip of what a salesperson is doing during COVID. Well, the salesperson basically took her cell phone and went into the car and showed the customer exactly what features the customer. So those types of things. So the key thing behind that is, what is the company doing to match product to customer and make those needs met? And the quicker you can do that, the higher velocity you can have, and the snowball effect can happen. So the other thing that in terms of velocity, EBITDA margin can tell you this, the profitability of each transaction. So you take the turns and the EBITDA margins to give you relative advantage. And we'll see in the example down below of the ROE is basically a function of inventories and EBITDA margins. And so you can say, okay, if you're looking at from a car dealer perspective, the new and used sales return on equity is going to be turns times margin times leverage. And so basically the leverage aspect we talked about before is basically it's provided by, can be provided by the OEMs, a low cost leverage. So that creates it. But the key piece is the inventory and margin. Those things go together to create a return on the equity that's associated with the auto dealership. So the service provides, and then for auto dealers, service provides high margin and the customer stickiness part of it. So from an auto dealer's perspective, that's how that aspect can fall into it. The nice thing about the auto market, as we mentioned before, is the top 5 publicly traded companies only hold roughly 8% of the market, at least according to one set of statistics. There's another set of statistics that say they hold even less, but in either case, there's huge amounts of this consolidation activity has been going on for 10 or 15 years, and this thing will probably continue to go on for another 10 or 15 years of these guys just continuing to consolidate and grow from that perspective. And so here's some examples in the auto sales service, give you an idea of the relationship between margins and return on equity. So if you look at the turns of these various businesses, you'll see, Asbury has a decent turns. CarMax has the highest turns, and CarMax is basically they're the used car company. So in essence, they're really dependent more on turns because they don't have the service and parts aspect of the business to sort of rely on as much as the core business does. Now, what's interesting, so then you've got Carvana. Now, Carvana basically has inventory turns less than CarMax, and probably roughly the same about maybe some of the other sort of mainline dealers. Usually what you'd see in most internet businesses that are doing well is basically they have higher inventory turns, therefore they can charge a lower cost in terms of an overall aspect. Carvana, for whatever reason at this point, doesn't seem to have gotten to the scale where it is, even though they are across the country from that perspective. And so that's an interesting anomaly. We'll sort of see how that plays out. And CarMax or Carvana does have some very specific things, I think, that will allow it to continue, that could allow it to continue to be okay, because their focus is more on sort of the less than prime and subprime customers, and their experience from that perspective is a quantum leap above sort of the traditional, used car sales type of a situation. So that's going to help them from that perspective. But in any case, this gives you some idea of how all that sort of plays out. So the other thing that we've done in terms of an evolution of process is doing a forward-looking valuation. And so what we're really doing here is trying to come up with a real simple DCF, do a revenue growth build up. So we'll just take a look. Okay, what are the key drivers behind revenue? Try to find out what they are historically, what makes sense going forward. Taking a look at what are the key margins. And one thing you can look at for margins is, okay, is there any operational leverage, as we mentioned before? There's different ways you can take a look at it. You can take a look at it historically, say, okay, some of these guys have been consolidating for a while. How much have their margins gone up over time? And then say, okay, going forward, these similar types of things can happen going forward. Or you can dive into the cost structure and find out which pieces fix. And then the simplification, what I've done is historically, you can take a look at, okay, you're going to, like, for example, if you take a look at Asbury down here, you're going to have a period of higher growth of this 10 to 20% growth, and you're going to get to more steady state out here. So what you can do is you can say, okay, you discretely model this revenue growth and the operational leverage associated with it, get the net income and the EPS associated with that. Then once you get out to a more steady state growth time frame, use something like a Graham formula or a Graham multiplier to figure out what it's really worth at that point. And so it's the combination of the two. And so what it really does is it allows you to basically take a look at how the key drivers of the growth of the company, and where most of the time is spent is on supporting both the margin assumptions, the operational leverage assumptions, and the growth assumptions in terms of that go into these specific items. As we're going through some examples, we'll sort of show you what really happens there. So some of the key growth drivers in terms of revenue growth are the organic, which in a number of these cases, that's really been a challenge across the economy today. That's why looking at companies in this way is very interesting, in that it doesn't really require a lot of organic growth. You're really dealing with more consolidation and under, below the line overall market growth to really generate a lot of the profit here. There's M&A growth, which can, again, you get sort of the synergies, operational leverage from that growth. The other thing that can enhance this, a number of companies have done, is they'll basically take on debt to do the acquisition, then use the cash flow to pay on the debt, and then repeat. So in essence, you have a series of public LBOs constantly over time happening. And then what'll happen too is that some of the better ones is they'll say, okay, if what I see out there is really high acquisition prices and my stock price is cheap, I'll buy back the stock. So we'll see in Asbury over time they followed various strategies. Where they started out basically just doing a combination of buybacks and acquisitions. And there was a time frame where they did a good amount of acquisitions and things got more expensive, and they focused on buybacks, and now they're back to acquisitions. So what the companies we really need to look for a company is sort of flexibility in terms of the way, how do they really deal with this over time. And the key thing I'm saying is to support the key assumptions behind this analysis. And basically that's associated with, looking at the firm's history, taking a look at when somebody can look at supplier growth or some other folks in the value chain, what kind of growth associated with that, and then competitors. And we've got the example here of Asbury, where right now you take a look at their growth over the next 2 years, 9 kind of growth. This is based upon just what the analyst estimates are. They have an expectation of growing revenues by 20% per year going forward. And so this is what we do to project it out for 5 years and then ramping it down to 10% after that. You've got the current net income margin and then adding operational leverage to that margin based upon the historical operational leverage that we've seen. And then we calculate EPS by basically having a certain amount of EPS here at current price. And so what this will do is, so right now, let's say we take a look at Asbury today. The current earnings free cash flow yield is roughly 10. But if you go out 5 years, it's only 2. So it really uncovers an opportunity that, okay, if you look at this business on the surface, you can say, okay, it's in a cyclical business, selling cars in a cyclical business. It's going to go up and down. So 10 is probably not a bad multiple. If it's in a cyclical business, it's probably growing 2 to 3% per year, which is sort of like what the top line growth would say this kind of business would be. However, when you dig down a little bit deeper and say, okay, well, there's other ways this business has grown and will grow going forward, it provides a real interesting opportunity. If you incorporate that into forward-looking projections, you'll get some really interesting results. And this is an example of sort of what's happening there. And we'll go through the 2 examples that we have here where you see that kind of situation that really requires a lot, being able to dig into some of the underlying assumptions, being able to model those, and then just see how that plays out in terms of the overall valuation over time. Okay, so we're gonna jump right into Asbury here. Asbury is we're gonna start. It's a great business model, and I think it's comparable or better than other online players, but there's significantly different valuations. So if you look at, like, for example, if you look at like the number of cars versus market cap, let's say that's really sold. So if you look at like Asbury, it sells about 200,000 cars per year. Its market value, its at market value invested capital is roughly around $5.5 billion. Okay, you look at something like Carvana that sells 35% more cars, but its value is $28 billion. Now, clearly, Carvana has some growth opportunities and stuff like that, but there's a very large difference between the two. As we go through, we'll see how I think the revenue growth of Asbury, while not as high as Carvana, will be able to incorporate some of the same factors that are driving the Carvana growth going forward. And so the one way I think the model for Asbury is better than, let's say, some of the pure online guys, is they get revenue from multiple sources. They get new, used, service, finance, and parts, and now they have the ability to do it online, which is a relatively new capability that happened in 2020. So they have like 5 different ways to get revenue. The online guys pretty much have, used online, maybe finance, maybe 2.5 to 3 ways. So in essence, they have less ways to basically, get revenue. The second thing is just the customer interactions. When you buy a car online, the focus initially is price. You get some convenience of price, and when that happens is when the focus is on price, and you're only going to typically have very few interactions. If you're dealing with a car that, let's say, you're leasing, you're going to be dealing with a company that's leasing, provides the leasing financing. You're going to come in for service. So there's a lot more touch points in regards to the normal, the more traditional dealers versus the online only guys. And if you look at the online only guys that have done well, like the car matches and the motor points in the UK, their model is based upon just having huge turns of existing business. To give you an idea on a relative size basis of these two markets, new cars is roughly 15 million cars per year. Used cars is 40 million cars per year. So they're on a relative size basis. Give you some idea of sort of what's really going on there. What Asbury's done is they've added online only in 2020, which is a huge improvement. So if you want to buy a car from Asbury, you can do it totally online now. You don't need to actually go into the dealership. And so that's a huge alternative for people that want to buy a car that way. To sort of give you a mix of the way that of Asbury's sort of combination of profit or the gross profit, they get 20% from used cars, 14 from used, 43 from service, 23 from finance and insurance, and that's that's typical of these types of businesses. It's not largely unusual. The other aspect of the business is that's interesting about Asbury is it has a higher luxury component than other dealers for the most part. Penske is the only one that has a larger amount, but they have lower margins than Asbury. But Asbury does compared to the other larger AutoNation, Sonics. They do have a larger luxury mix, which I think lends to more of the service and the stickiness aspect of the dealership. The other thing that's interesting is the company's developed as low debt and had average about 30% ROE over the past 10 years. So clearly, from that perspective, it's a good business in the sense of generating good returns on capital. In terms of how does it get there? How does it get this profitability and sales growth? They basically follow a 4-part approach. 3-part historically, internet's going to be new, but the approach has been to buy a dealership, pay down the debt with these new dealerships, buy back stock. And sort of that overall sort of LBO model has really helped them create a lot of growth. Now they've got internet, so they can add that to the mix of various ways to grow. In addition to growth, now this is just revenue growth. If you talk about operational income growth, you're also going to get from the synergies. The other thing that Asbury's done is they focused in clusters. So if you look at them versus, let's say, the footprint of AutoNation's across the country. Asbury is just in a few markets. And when you do that, you can focus and you have a clustering effect. And the economies of scale, these businesses are local, they're not national. And so that's sort of where their focus has been. That's why they've been able to get higher margins, but they're not the biggest company out there because they have these local clustered economies of scale that they've actually been able to take advantage of. Now, the thing about this business, which is really exciting also, it's a very large runway. This company has about 0.7% market share with this growth to continue that can go on for another 10 or 15 years or more. I mean, the market's just huge. And so it's really a model that's been historically proven to work. And now it's a matter of just repeating it going forward. Now, there's going to be some changes with the internet, but I think given their internet-only approach to the way that they've done stuff, I think it helps out. I mean, as a testament of how they've been willing to adapt to this, is they had a previous sort of automated system in their dealerships that they were used to schedule service appointments. They found that system would not support an online-only purchase option. So they scrapped the whole system and put a whole brand new system that basically allows people to do stuff online. What that tells to me is the management team is willing to basically not look at sunk costs and basically just focus on, okay, well, what's going to be the best for the customer and what can we do going forward? So that's just an example of sort of the way that I think I've seen the management team sort of maneuver in the past that provides a real interesting insight into the way that they think about things. Again, we talked about sort of online purchase option is ClickLine. It provides accelerated growth. The interesting thing about it is that you can, if you buy a car online, there's very little incremental investment that they need to make. They basically need to deliver the car to you, or if it's a mutually agreeable place for you to pick up the car or the automobile that you've got. And they were the first ones. I'm sure there's other people that are going to be able to do this, but they were the first ones that were actually able to do a full transaction online, dealing with the local, titles and all the other sort of local regulatory aspects of buying a car. They were the first ones to do it. Not that that's necessarily going to be unique, but it does provide you a little sense of, okay, these guys are thinking ahead in terms of the way that they to stay on the edge of sort of doing this from a traditional dealer basis. So if we look at the U.S. the overall auto dealer business in the U.S., the key things in terms of recurring revenues for automobiles is there's a service aftermarket parts, which provides some, which correlates more to miles driven versus in automobiles on the road. So that's a nice recurring revenue stream that they can get in an increased customer touch point. Demand will increase with autonomy, electric cars, and car sharing in terms of overall demand for cars and service. The key thing about this, if you look at the service aspect of it, is that as autonomous driving happens, you're going to have every car is going to need to be, the sensors are going to need to be calibrated. And that's a huge service bump up, bump up in terms of what's going to happen going forward. And the other thing is, I think as cars get more technologically evolved, I mean, you take a look at a car like a Tesla or more of these advanced cars, it's more like an iPhone on wheels to a certain extent. And so as the stuff gets more technically sophisticated, it may be more reliable, but there's still going to be, I think, a big, huge value add of people being able to bridge that gap, people to help people out to figure out how does this stuff going to work and that kind of stuff. So I think even though the service aspect of using an internal combustion engine is going to decrease, I think there's other aspects of the automobile in terms of service and what people are really going to want is still going to be there. It's just a matter that the service and things are going to change. And there's a company actually in Sweden where there's a lot more EVs on the road right now there. And so they're on the cutting edge of what's really happening with this. And what they found that the service component doesn't go down. It stays about the same. It's just the combination of what they do is different. And that company's still been able to maintain relatively high ROIs despite EVs replacing internal combustion engine cars. So again, we talk about sort of the key aspects of the business. The large auto dealers are good businesses in the U.S. They're probably making mid-20s plus ROEs. Most of the dealer profit comes from finance, service, and aftermarket parts. We've talked about the vertical integration. They vertically integrated into finance, service, used cars. From that perspective, new car sales have lower profit margins, but are financed with floor plan financing in regards to the inventory aspect of it. And you've got sort of this consolidated, fragmented market when it comes to auto dealerships. Now, the way that dealerships are typically broken out, there's premium and mass market. Premium ones, dealerships pretty much have, it's going to be more of a higher touch, higher service type of a segment versus the mass market, which is more of just people just buying cars from a mass market perspective. So here's an example of Asbury, which is the subject company we've got here. These guys have done a really great job, and it says the EPS growth has gone between 9 and 18% despite the same store sale, the autos that are actually being produced flat or recovering over time. So this is an example of how a company in a stagnant industry can create growth. And so if you look at the timeline here, they started out, they were sort of a decentralized roll-up. Then what they did there is they started to pay dividends as the opportunities basically started to dry up a little bit. They had a recession restructuring, so they did repurchasing and acquisitions. And there was a period of time between 2014 and 2017 where they bought back a third of their shares. And so again, this flexible approach of depending upon the situation, knowing what's going on. The key aspect that Asbury has that some of the other companies may not necessarily formally have is Asbury actually has a capital allocation committee where it's taken and refined this approach and basically use their well-defined strategy of how to really go to market and basically execute this. And so it's really an interesting approach, and it makes it more a question then of execution as opposed to trying to deal with a lot of the other sort of uncertainties that other companies can have. But this is just an example, and you'll see that the growth has been really good over time from this. So we've talked about what you'll see here is that the companies you've got growth rates of 8 or 9%, which is sort of a combination of GDP growth plus some acquisition growth. But while that's turned from an operational leverage perspective, it's turned from 8 to 9% to 20% in terms of EPS growth over time. As we mentioned, capital allocation committee is part of the board, which is interesting. It's unique. I don't know of any other company that's done this. One way to take a look at this is, okay, let's take a look at the security returns. It's got a debt interest rate of 4%. Common stock trades at roughly around 10 times adjusted earnings. You combine earnings yield plus growth, you're getting 25%. And so you get a yield of 6%, which is relatively low given the 20% growth rate. And so the implied EV to EBITDA, looking at this X floor plan or not, is roughly around 10. So I mean that seems to be it's a typical amount, but for this kind of a growth company, typically those numbers would be bigger. And so some of the challenges we had mentioned, sort of the service needs for EV and hybrids, but then I mentioned Bilia, which is one that you can constantly look at and sort of say, okay, well, what's happening with Bilia? Because in Scandinavia, there's many more EVs on the road, and what they've actually found is the ROEs have still maintained where they are despite what's happened with that. So if we look at the other thing you want to take a look at is what are the management incentives? How is management specifically incentivized to run this business? Now, right now, management owns less than 1% of the company, but it's still a relatively large amount. The CEO owns $10 million worth of stock. I mean, this is a $3 billion company, so he clearly has a good amount of stock incentive there. They do have minimum equity ownership percentages, so the CEO needs to have 5 times his salary. Other management have to have 3 times their salary. The way the incentive compensation is broken out, it's roughly 30% base, which is about $1 million, 70% equity incentive, cash. And the cash options is very interesting. One thing I like to look at is what are the incentives these guys have, and it gives you an idea of how that's really going to sort of play out. So the cash incentive is based upon EBITDA growth at various levels of U.S. car sales. So it's a very interesting thing. I'll say, okay, here's the EBITDA growth we would like you to get. It's tied, so it scales with car sales. So what it really does is it provides an incentive for the management to do well. So it's not like they set a huge target and if car sales goes way down, they're never going to meet it. It gives them the opportunity that what they're really looking for is relative outperformance versus other people in the marketplace. And then they have equity incentives, which are primarily stock grants. 60% are performance based, 40% are time based. Here's some of the key metrics they have for the performance base: 3-year EPS growth, operating margin, same store profit service, gross profit growth, same store used sales growth. And so those are sort of more, metrics that would build up into a better ROI at the end. And then they overlay this with total shareholder return, so they compare their return versus other car dealers. And if their relative shareholder TSR or the shareholder return is higher, then they scale it up by 10 to 15%. If it's lower, then they scale it down by 15%. So they look at this thing from multiple ways, and this is applicable to the 60% of the equity performance they provide. Now, overall, the company is granting about 1.1% of equity per year, which is modest. It's not hugely diluted. So in essence, you have a incentivized management team that's making good amounts of money, some well thought out incentives. And so you as a shareholder basically are getting this management team for about 1% of equity per year. And I think it's a very good combination of both for the money you're paying, you're getting a good set of incentives and a good setup here in terms of a well thought out strategy for the company. So we'll go into this is what we had mentioned before. Here's the forward-looking valuation. Right now, they expect to get 20% sales growth Right now, they're saying the way they build it up is to saying, okay, 4 to 5% same-store sales growth. If you take a look historically, the same-store sales growth has probably been three, 3 to 4%. M&A growth 4 to 5% annually, which again, if you take a look at the 7 to 8% revenue growth, okay, that gives us, we're getting close, maybe at the high end, but in essence, it's still within the ballpark of historically what they've done. They're expecting 10% internet growth annually, and that's based upon what their expectations are for that. Now, if you look at the one other company in this industry that has an internet-only option, that has had internet sort of part of their way of looking at selling autos probably for the longest, it's a company called Lithia Auto. And their overall amount, they're expecting 31%, including all these. And so these guys are being a little bit more modest than those guys, than Lithia. But Lithia also has some very interesting aspects to it. They have a common shareholder, basically, that owns very large stakes in both companies, Abrams Capital. And so there's some cross fertilization there. And the other interesting thing about Lithia is if you look on the Lithia's board, and when they started getting into internet stuff, they had a guy from Google that was the Google guy that was associated with auto, basically the collection of auto data and auto benchmarking. So he basically came on the board, and then they started to get into this internet strategy. Now, Asbury's doing the same thing. And so therefore, I think it's the way to go in the future, in a way to really sort of capture some of the growth that's now being captured in the price of Carvana and Bloom and the other online only guys. I think these guys are going to capture part of it. And so I think the market's big enough that everybody will get a piece of it, but it's not really being reflected in the price of more of these traditional car dealers. And so if we look at some of the operational leverage historically, what's happened here, the margins have tripled roughly with revenue growth. So that's sort of showing historically what could happen with this business. There's local economies of scale and clusters, as we had mentioned before. And this operational leverage from growth. And again, sort of the competitor to Lithia is looking again for 34% growth. So these guys are looking for lesser growth. So okay, yeah, another competitor market that's expecting this type of growth with this sort of integrated internet / M&A traditional dealer kind of a model from that perspective. So here's just a comparison of just some of the other auto dealer sort of valuations that you've got here. So, you got these are the traditional guys. You'll sort of see, okay, right now you got Asbury with about a 10% PE, and then Lithia with a 15. Again, those are because of the internet sort of aspect of the business. And then you have the other auto dealers they're a little bit lower, that don't have quite the internet integration. I think at some point everyone's going to get into it, but at this point they aren't quite as to that incorporating that into their models at this point. And then you've got companies like MotorPoint, which is probably similar to a CarMax. Those are more highly valued just because of their revenue growth characteristics going forward. You can take a look at the inventory turns here, as we mentioned before, for these various companies. And so what you've got is, you'll see the higher ones like Asbury and CarMax have relatively the highest ones. They still maintain on a relative basis higher inventory turns as just a result of the underlying economic characteristics of the businesses being better than some of the other auto businesses. But overall, I think the businesses are in general very good businesses. So we'll conclude in terms of Asbury here. So the current valuation roughly is about 10 times earnings, 2.5 times 2026 earnings, as we showed in the model previously. We use Graham formula in terms of a fair valuation. If we're assuming just the 4% organic growth, we get about a 16 times margin, 16 times multiple, 14% with M&A, you get roughly around a 28 should be a fair multiple. If you add the internet in there, you get a 24% growth, which is about historically what they've been. Again, this is looking 5 to 7 years out, and you get about a 56% multiple. So you can see with these multiples, using sort of a standard fair value type of calculation, you're getting a wide range of what this thing could basically be worth. And what you're really doing is you're buying growth for more than a reasonable price, and then getting a combination of inventory turns and margins. This is the best combination that I can see of inventory turns and margins in the U.S. dealer space, and you get upside from net growth from that perspective. So I don't know if I want to stop here. If there's any questions, I don't know if there.
So
any questions?
it does look like we have a couple of questions that have
Okay.
rolled in here. We can go ahead and jump into them real quick.
Okay.
one of them coming from WK, one of our usual viewers here, asking when you're looking at UK companies, as you mentioned a couple here, some competitors for these US companies. What are you looking at, I guess, as far as their reports? Obviously, no 10Ks or 10Qs over there. What equivalents are you using to kind of bring in some of that information?
Yeah, I mean they do both the companies that we've looked more closely at, Cambria and Motorpoint, have pretty extensive annual reports. The annual reports will have a lot of the information that's in there. And so I think in terms of comparable to the 10Ks, they maybe they have some stuff that maybe isn't there in some cases. They have some stuff that is there. In both cases, both companies do a pretty good job of laying out the business and what are the key drivers there. So I think for UK companies, that's been the case. And the same thing with some of the Scandi companies. If you look at like Bilia, has that type of stuff. Carmox, which is another one that's in Finland, has the same deep disclosure. There's actually one in China. It's actually a pretty good company. It's the only one I've seen where the CEO says our focus is inventory turns, and you can see it. I mean, their inventory turns are twice anyone else's, and the ROEs are just through the roof. So, I mean, I think, what you're really dependent upon in foreign situations is probably more voluntary disclosure versus mandatory disclosure in the US. And most of the ones that we've been looking at have pretty good voluntary disclosure.
Understood. And continuing on, looks like we have a question here. I'll see if I can word this in a way that's not too targeted. But when it comes to allocating capital, as things are becoming increasingly expensive, and some would argue we're in a bubble, I guess how would you say that you justify going ahead and buying into these companies when they might seem overpriced to other people?
I think part of it is just looking at the underlying economics of the business. That's how I get confident in this. I'm clearly like the viewer had said, there are some companies that are selling for very expensive, and that's one of the things that the evolution of the process that we've gone through is to think about, okay, what's this business going to look like in 5 years, and what are supportable assumptions to get us here for 5 years? Because you could clearly see a case, and we'll see that in Consolidated, where you look at it based upon today's earnings, and it looks okay. It doesn't look and the same. But if you look at the assumptions that what could this thing grow into in 5 years, support those assumptions with data that you think is reasonable from both the company comparables and market, to come up with a scenario and say, okay, so like even look at like this company, say, okay, Asbury, 10 times earnings. If you look at it as a cyclical business that's growing at 3 to 4% a year, and you see all these cycles and stuff like that, you could say, okay, 10%, maybe you're at peak earnings. That makes sense. But then when you actually sit down and look at the business, not only prospectively, but historically, what's happened with this business, you'll see that that's not the way this business is. If you covered up the name of Asbury and you said, what would you pay for this business that has this kind of growth? It wouldn't be 10 times earnings. And you had supporting assumptions that would say this growth can continue, this 20% earnings growth can continue for the next 5 to 10 years. There's no way you'd pay 10 times earnings. But but I think what happens is with these cyclical businesses, people put them into sort of bins, and they really don't. What I find incredible with a company like Asbury is it's not like something that it's not like their plan, right? I mean, they've done it. They've done it over the past 10 or 15 years, and they've grown, and they've done well. And then you got not only Asbury, but you got Lithia. And you got some of the other guys maybe not growing twice as fast, but you have two examples of companies that have done well in the past that are going to try and repeat that in the future. And then in addition to that, you've got these online guys whose valuations are hugely more expensive than these guys. Okay, but these guys can get a piece of that and actually maybe have a better model than some of these online only guys, but it's not reflected in the valuation. So I mean, those are the kinds of things that get me really comfortable, specifically with a company like Asbury. But I think that the key shift in approach is you need to think about, okay, well, what's going to happen 5 years from now? And basically, to get comfortable with that, you need to understand those assumptions, dig into them, and see can you get comfortable with them. If you can't, then you're right. Then there's not much you can do. But that's part of I think the modern process of going through and trying to find interesting ideas is being able to dig into that and say, okay, as we'll see in Consolidated, the future may be different than the past. Being able to dig into those assumptions, really understand what's going on from that perspective, and then making an investment decision based on that, as opposed to just assuming, using current valuation multiples, which sort of assumes the past is going to be the same as the future is going to be the same as the past.
Understood. And one more question here before we can move on for a brief look at our next holding here. Question from another one of our usual viewers, Praveen, here, asking, when it comes to the actual portfolio, how do you go about balancing those positions? How many do you like to have? Are you weighting more heavily on some than others, or is there a kind of nice spread across the board?
Well, I think what I found is okay. So right now we have about 20 positions. Historically, we were sort of in value special situations. Now we're adding more of these kind of situations. And to a certain extent, I mean, I'll put in, 5 to 6 to 7, maybe 7% on a cost basis of some of these things. And if it grows, and I see, okay, the valuation still seems to be reasonable. Like, for example, Ash Cheat's an example of this, where we bought it at like 15 and now it's like at 50. But you look at it, you say, okay, the valuation still seems to be reasonable. I'm just going to hold on to it and let the market sort of dictate, saying, okay, this is a good business overall. Here's sort of what we're going to do. Now, if it reaches 20, 25%, given that it's a fund, I would clearly then say, okay, what others? But we haven't quite gotten to that point yet. But I think when the positions do get large, like 20, 25%, at that point, I think you need to reassess and sort of say, okay, you know, unless you need, I usually at that I'll try to find something else with equal amounts of upside, because the real question on that one is, you're dealing with volatility, and when you're managing a fund, people will be okay with a certain amount of volatility, but they're clearly not going to be expecting a blood curdling up and down 50% type of thing. Even though you can make great returns that way, there's, from an investor perspective, it's more difficult to do that. And so that, because the timing on these things in terms of when they play out is not known going in, and it can vary of when it happens. I mean, it can be flat for a number of years and then it just gets recognized that it happens all at once. It can happen over time. I mean, the nice thing about these businesses where you're digging into the business model, generally what's happening is, and it has a decent amount of growth, usually what's happening is over time you'll get a more gradual increase in value versus a lot of the pure deeper value stuff where it can chug along and it may not be growing that, and at some point it gets bought out and pops right up. So I think that the return profile of more of these kind of businesses that we've been looking more at, which are more of the franchise kind of businesses over time, those kind of businesses I think have a more smooth return profile. So I think that's sort of a combination of what we can from that perspective. So
Absolutely.
so
All right.
we can move on to our final sort of situation we're looking at here, a company called Consolidated Communications. Now, this company is a legacy telephone company. They bought a few companies, rolled them up over time. They've got roughly around 180,000 voice. We got the numbers here in terms of the subscribers they've got. Right now, they've got about 270,000 or 300,000 gig passable homes, which is a key thing in sort of this fiber build out thing. They're basically going to add 1.6 million, so we'll have 190 million total homes that are passed from being able to provide gigabit type of connectivity. One of the unique characteristics of the company I think that really is favorable is in 81% of the markets they only have one competitor. So that means the penetration rate of this type of a business is basically going to be close to 40 or 50% if everyone in the market is going to get this kind of service. Unless there's so in essence, and if you're providing better service, you may be able to get over 50%. And that's what Consolidated seen when they've gone into new markets. They've only been in them for a year or two. They get 30, 40% penetration rates. Some markets they have no competitors; those are even better. And then 8% they have two or more, and those ones you're probably not going to have as much. But the mix of the markets they have, I think, is very favorable here. Just from a top level perspective, what's really happening in this market is that you've got a series of incumbent players Okay, Consolidated being one of them. You've got some smaller independent guys. You've got AT&T. You've got Frontier coming out of bankruptcy, and what you got is they're replacing their old DSL copper links with new fiber optic links, which allow for a lot more bandwidth for people to basically use because the demand is there for that at this point. And so what's happening is Consolidated is basically accelerated their rollouts. The next 4 years, they're going to have this, almost 1.9 million total of these homes passed in regards to being fully gigabit capable in terms of being able to provide that connectivity to customers. And so the other thing that they're working on, which is interesting, is they want to develop a high NPS experience. So they basically hired executives from Google Fiber, which has the highest NPS of any cable company out there. And so basically it's a high NPS fiber subsidiary. The interesting thing about this is here in Rochester, where I'm at, there's actually a company called Greenlight. It's actually doing this on the private side. And there's a number of them. I probably would say I've heard of at least a dozen, or maybe more, of these small privately funded companies that are providing broadband access to customers because people are just so fed up with the cable companies. And so this, to show you an example, like here in Rochester, people were basically going around neighborhoods. This was of their own time. They weren't paid by anybody to do this. Going around neighborhoods to collect signatures, to collect commitments, to basically get this service to come to their homes because the cable company has just such poor service. And the cable company still has it. I mean, the thing I find incredible is for all the businesses today out there that are considered to be great businesses, the ones that have the worst service, they're still able to survive. And the cable companies have that at this point. And from what I can see, and I think that's going to be a bigger problem overall, is right now they've got the advantage in places where they've got a bigger pipe. But as these other companies are building this bigger pipe, the customer service is going to be a huge difference. And I think trying to change a culture of an organization to become a high customer service organization from a low or a poor one is going to be a big pull for these cable companies. So I think it's going to be interesting to see what happens. But I think these guys right now, the way they're valued, and we'll see there's a very interesting slide later on that sort of shows this. These guys are not valued; they're valued as though they're going to die. And if you look at the plan that they've got, there's a fully funded plan. It's not going to happen, at least from the numbers that I've been able to model out from that perspective. So if we go into some of sort of the benchmarks that we have here, so the core business, part of the problem with a lot of these businesses is the core business is declining. If you model this out, sat down with management, said, okay, well, let's go through each one of these lines. The core business is going to stabilize by 2031. The fiber overlay is going to add, accelerate revenue growth, add incremental revenue on top of that, and accelerate revenue growth of 5 to 6%, and EPS growth of 20% over the next 5 to 10 years. Because the way Consolidated is set up is they've got the interconnections amongst the cities. They just need to fund the connections from a central point to the homes, and that's a lot less than it would be to start with the whole thing from scratch. And what they've seen is, so given the low competition in most of the markets, they think 40% penetration is probably reasonable in terms of what's going on with these companies. The key thing is the incremental profitability is going to be high because they're going to use an existing infrastructure. Management has stated that they think that EBITDA can approach 50%. This is just sort of an indication of how much, incremental profitability can be added to these things. These guys have economies of scale because they have focused footprints to be able to do that. If you do an IRR, unlevered IRR calculation, you're getting roughly a 17% unit economics from the fiber build out, assuming a 70% high speed internet sort of pricing, which is sort of like the average pricing around the country now. And the nice thing about these things is once you get the network set up, run to the houses to basically provide higher bandwidth, you just need to drop in new electronics. The upgrade cost is a lot smaller than what the initial cost is to sort of labor stuff. Right now, they've got about a 5.8% cost of debt. That should go down over time, but you just look at that spread, and the company does have some leverage. So in essence, you're taking advantage of a trend with a leverage, with a decent spread, with a fully funded plan, with a partner that's done this before. So broadband, just the overall market, it's a number of different players. You got cable, traditional telecom, wireless, and overbuilders. It's a local market, as we mentioned before. It's more competitive in the urban markets, less so in the suburban and rural markets, where a lot of consolidated market is at this point. Local markets can further be consolidated. Right now, I think gig speed internet is considered a core infrastructure service. The government is going to put $40 billion to the states to provide additional access. Now, what form that'll be in, it's still to be determined. It could be subsidies to people. It could be actually funding some of the networks, but this is a high priority. There's a lot of money that's going to be going towards it. And like I said, there's many privately held overbuilders that have happened. Greenlight being an example here in Rochester, and probably other people around the country have probably seen that happen at their local communities too. So in these companies, basically, if you look at them in the private marketplace, are being priced at very, very high multiples, like 20 times EBITDA has been more of the local private guys. So there is clearly, the market clearly thinks there's value here from that perspective. What's really driving this is the 30 to 40% per year growth in broadband usage is expected to continue to grow. And so you're going to have multiple growth things here. You're going to have this base growth of 30 to 40% per year in terms of usage, but in addition to that, you're going to have increased broadband penetration. So those things are really going to be the growth drivers here. And from, I think as time goes on, more and more of these applications are going to use more and more of the bandwidth. Part of the thing is you have a chicken and the egg thing. Once the bandwidth's available, people will make applications that use this additional space. And it's really going to create a very interesting sort of, I think, to have this sort of a flywheel or whatever that just it sort of builds on itself over time. And you get these really fast gig connections, and these companies should be able to make some really good economics going forward. So in terms of the key things that have happened with Consolidated, in terms of some of the management incentives, they have basically fiber rollout metrics, which is something that's changed in the past. What happened here was that they basically they had a lot of debt, and so they brought in Searchlight as a private equity firm that provided the financing, the growth financing for this fiber layout. And as part of that, they brought in like the guys from Google Fiber. Searchlight's as a company that's been involved with a number of these other fiber build outs in places like Italy, Puerto Rico, Israel, so other places around the world. So they've got some experience in terms of how these things really work from that perspective. And so I think they bring not only capital, but they bring expertise of how this rollout stuff really works. So that's that. One of the things that happened there through that transaction, though, is that they do get a good amount of equity for providing this capital. But I think their choice was at the time was to say, okay, we're either going to delay this and do this over a long period of time, or we can get the capital today and do it over a given period of time and then take advantage of this opportunity. And so right now, you're investing on a post-dilution basis. You know the total number of shares that's going to be diluted. Even in that, we incorporate those numbers into the analysis. The company still is relatively inexpensive. So if we look at what's really going on now, so the debt interest rate on debt is roughly around 5.8 in terms of an implied security return perspective. The common stock trades at 9 times adjusted earnings. You add the earnings yield and the growth together, you get 25%. And again, this is sort of similar to the situation of Asbury. The implied EBITDA is only 5.5. Most of the other players are relatively high. We'll see in the trend as we go towards the end here. We've got some transactions to take a look at other benchmarks in the marketplace in terms of what's really going on. Some of the key assumptions in the challenges here is what's the final penetration rate and what's the speed of the penetration. In our model, we've assumed a 5-year penetration rate of reaching 40%. Could be higher than that at the end, but that's sort of like the assumption we've used, and it's gradually happening over a 5-year period and model that on top of the core business that we previously talked about. And there could be price competition from some of the incumbents. I think that's to somewhat is mitigated here in the fact that they have a lot of markets where they are either there's only one or no competitors. I think in the 8% of the markets where they got multiple competitors, that may be more of the issue. But in most of their markets, they have one or no competitors. So I think that becomes a little bit less of an issue for Consolidated versus let's see some of the other competitors that are in more competitive markets. So again, we take a look at the management ownership here. Management owns about 1.3% of the shares. The CEO owns about $8.4 million worth of shares. The chairman of the board, roughly $2 million. Ownership's about 1.3. Again, they have similar sort of equity ownership levels as Asbury. These are multiples of what their base salary is. The guy that's running this business makes a base salary of $600K, which I think is very reasonable given the enterprise value of the business is about $3 billion. He is 20% base, 80% of incentives. And we take a look at the incentives. You have a cash-based incentive, which is basically based upon, adjusted EBITDA, penetration rates. Historically, it's been based on adjusted EBITDA on revenue, but now the focus has been on the specific metrics associated with the rollout of the network. The equity incentives are based 50% performance, 50% time. Again, so they've used the same sort of metrics there in regards to cash incentives, and again with sort of this 3-year relative total return overlay, similar to Asbury in regards to it bumping up and pulling it down. So it's a very similar kind of a structure in terms of the way they incentivize the guys. And again, we have modest 1.3% equity grant per year. I don't like to see more than 4 or 5%, but 1% I think clearly is sort of a good trade-off here, given sort of what you're getting here from a potential upside. So again, if we look at a forward-looking valuation now this one, there's a specific build-up I've done, which isn't necessarily in here. If people are interested, we can call me, we can talk about that afterwards. But in essence, this is sort of a combination of taking a look at the core business and the build-up on top. These are the resulting revenue rates, net income, and then EPS per share numbers. So what's really happening is a combination of core revenues declining initially and stabilizing, and fiber revenue creating growth. Management provided the core assumptions. The fiber rollout, again, penetration rate over 5 years from 10% the first year, 40% in the last year. And we're assuming the broadband revenue of roughly $56 to $60 a share, and then increasing 2%. That may be light. I mean, if the cost of adding new stuff isn't that high, then in essence, if the demand goes up, I think that's it. Once they get in there, it should be a decent business. The fiber rollout, we use the interconnect technology. The connection cost is going to be roughly $350 per pass per house, and $400 for user equipment. The operational margin is going to basically have some operational leverage here, as we mentioned before. And then what's going to happen is the debt. This is a situation again where they'll have a debt pay down similar to Asbury in regards to the debt being able to pay. As the cash flow comes in, the debt will pay down, and you get that kind of similar kind of a situation there, because once the initial network is funded, incremental amounts of costs going forward are expected to be pretty nominal in terms of just keeping the network in place. So this is a very interesting slide. This is from Frontier Net's presentation. They came out of bankruptcy. I think this is probably one of the better graphics that illustrates sort of the value discrepancies between the various companies in this business. As you'll see, the cable companies are over up here to the right. Okay, so these are broadband providers for cable companies. So what they've done here is they've taken, here's the penetration rates, and here's what the enterprise value is per passing. So as you'd expect, as the penetration rates are higher, penetration being the number of connections you have per passing. So the cable companies have relatively high penetration rates at this point. They're selling anywhere from, it's like 3.5 to 4.5 thousand per passing. Now, Frontier is coming out of bankruptcy, and here's sort of what their passings are today, what they're expecting their passings to be in the future. If you look at Consolidated, it's way, way down here. Okay, and that's because it still has a lot of the copper pieces in. So once Consolidated gets its 70-75% completed network, it's gonna pop. It's gonna pop like right up to here. Okay, so its value, the penetration rate will probably be 30-40%. So its value should be like above $3,000 per passing. At that point, the value is going to be quite a bit. So I think this is a very interesting slide in the fact that it allows you to compare cable companies to these other companies who are sort of moving along this process. Recently, Cincinnati Bell was bought, which is this data point right here. These guys are again sort of laying out a fiber optic link. You've got WOW, which is an overbuilder, so their penetration probably isn't going to be grow very much because they probably already have 2 or 3 guys in the market, so their penetration is going to be somewhat limited. And then sort of the anomaly here is cable one. I think part of the reason why it's up here is because people are anticipating they're going to continue to grow, and some of the growth is captured in the, if they can buy companies down here that, eventually they may end up somewhere over here. But in any case, this is just, I think, a very interesting slide from the Frontier sort of emergence from bankruptcy presentation that I think really sort of describes and pictures what the valuation discrepancy is out there today from between sort of these guys that are building out fiber networks versus the guys that already have built out broadband networks. So, and then this is just more details. I won't go into some of the specific things, but these are basically just comparing, again, doing a 5-year model forward, taking a look at each of the components and sort of incorporating those into the modeling. You can see Consolidated is, amongst the cheapest today. And even if you're looking 5 years forward, that would still be a relatively cheap given sort of today's price. And so what Consolidated provides you is an ability to basically play this fiber optic rollout theme with a good amount of leverage in terms of a company that's levered at this point, so you get some decent upside. I mean, I think what you're probably talking, $40 to $50 per share, and it's selling for $8 now. If you sort of use some normalized assumptions here, either the per passing number and or basically sort of like the grand stuff we talked about before, using a decent terminal, what a reasonable multiple would be amount at the end there. So again, right now it's 10. The PE is 10 using the grand formula with a 7% growth. You're getting about double that. That's sort of the organic growth, but 20% with 5-year growth, which includes the full aspect of the whole plan. You're probably out to 45. So you do have some decent upside here too. I think both of these ideas, as you can see, if things play out as I expect, I mean, you can get multiples of upside. And I think the thing that's unusual about these, as one of the previous viewers had said, is today's market appears to be expensive. But I think in these sort of niches of these areas, you can find some of these situations that are interesting. There's growth beyond the projections from further consolidation that can happen in the market. I haven't included any of that. There's other privately held firms, sort of another sort of data point here, that being valued at 20 times EBITDA just because of the ability to roll these things up and what they're going for in the marketplace. Cincinnati Bell, which is sort of an in-process fiber rollout company, was purchased for 7 times by the first. Brookfield came in and gave them an offer, and then they were outbid by McArray. And I think it's the same playbook there. So you've got a lot of private equity players basically in this market that are paying in the private market much higher numbers right now than what's actually being reflected in Consolidated's price. And if Consolidated's rollout is successful, I think you'll see the upside that's associated with that. And that's it. And these are just some information about contact me in terms of information along those lines. But if there are any other questions, I don't know at this point. Let me see. Is there any other questions that have come in?
We do have 1 or 2 more
Okay.
that have rolled in that we can go ahead and hit on real quick before we round things out.
Okay.
Another question coming in here looks like asking increasing amounts of money going into the passive S&P 500 ETF, increased money going into those ETFs overall. Do you feel like active investing is starting to die out, or do you think it's just in a little bit of a lull at this point in time?
I think it's more a lull, but I think you need to be focused and try to find opportunities like we had mentioned here. I think it's investing in sort of these niche places that's really going to be an area where you really can see. First of all, is identifying the change and then quantifying how that's going to change valuation. I think is a key part of it. I think just investing in a basket of relatively cheap companies isn't going to get you a whole lot. I think you really need to drill down into the things and see where the change is, because the valuation aspects and what the market's current assessment of these companies, for the most part, the current assessment of the businesses is reflected in the valuations. Some of the things that you're trying to look for are maybe differences. Like, for example, when Matt talked about both Asbury and Consolidated, clearly there's other benchmarks of companies that have been successful that are selling for much higher multiples. So you can see the market has validated that aspect of it. The real question is, at that point, is will these companies get there? Will they transition from where they are to where they to where the market thinks a growing businesses in both of these segments could be? And if that's the case, and part of that is from the analyst perspective is digging in and sort of understanding and trying to support these assumptions. Do these assumptions make sense? Do they not make sense? Where the risks are, where the uncertainties are. And so I think that's the overall process. And I think if you do something like that, I think you probably will have a much better probability of success versus just buying cheap stocks. I mean, I think to a certain extent, there's computers and other things that can buy the cheap stock type of approach a lot better than humans can. And I'm not sure whether I think some of that is there still may be some left, but I would much rather rely on understanding an underlying business change that may not be reflected in the price, and then following that as time goes on and sort of seeing, okay, if it seems to happen, especially if you're dealing with companies. I think some very interesting companies are looking for companies that do a lot of M&A, where it's not going to be reflected in the analysts' expectations going forward. They're constantly going to be outperforming what the analysts think is going on. And if you can find businesses that have successfully done that over time, I think what you'll see is the charts go up and to the right. And what that's really telling you, if the chart is going up and to the right, that's telling you that the market didn't reflect these new things that are happening over time, right? I mean, if the market anticipated the chart would be flat or it would be close to the risk-free rate or whatever, but the up and to the right to me is telling me the market, there's still events out there that the market isn't anticipating that's being reflected in the prices as time goes on. And so it's a question of the security analyst to try and find out, well, what could those events be? I mean, one of them we talked about here is the companies that are doing M&A, maybe doing some consolidation and stuff like that. I think those are fruitful areas for people to take a look at.
Absolutely. And last final question here. Rough prediction, in your opinion, what the runway for fiber rollout will be here in the U.S., potentially compared to other countries?
I think the fiber rollout in the U.S. is, the difference between the U.S. again, it very depends upon country, right? I mean, I think the U.S. Is going to have a bigger runway than, let's say, maybe somebody like Korea, because Korea is very concentrated. All of its population is in Seoul. They've had the fiber rollout there. There's going to be a large growth in that market in the utilization and using 5G and Internet of Things and those kinds of things versus in the United States, where we have a much more disparate market. You still have some penetration. I think it may be towards the higher end of penetration, but what really isn't penetrated in a lot of the U.S. markets is the fiber optics. So you'll see these rollouts like what Consolidated is doing. You'll see like what Frontier is going to try and do. So I think you probably have another 5 or 10 years in the U.S. where that's going to happen. But then you get into other markets like Italy. In Italy, there's places where there's just no fiber optic sort of rollout at this point. There are these areas where it's not economic to do it. Now, the one thing the United States is doing is we are providing money to basically subsidize places where it's non-economic to do it. But I think on a relative basis, I think the United States is somewhere in the middle. The internet isn't quite as big as in some European countries. I think a lot of it really depends upon the concentration of the population. The places where you have very densely populated areas, providing the service is relatively easier because in essence your networks are all there. The United States were spread out, so the networks are going to take more time to basically develop over time. But I think we're somewhere in the middle. I still think there's some interesting growth opportunities. Like the other areas we're looking at are places like Italy is interesting. There's emerging markets like the Philippines that are interesting. But one of the challenges in each one of those markets is trying to find a situation where the company's a pure play. Most of these businesses that are doing this, like Frontier, or let's say like some of the other guys like Windstream, or AT&T. This is a small portion of a bigger business, and you're not really getting a pure play. You're getting this as one piece of a bigger telecommunication sort of package. The neat thing about Consolidated is when they get done with their rollout, this is going to be like 70 to 80% of the communication package you get, versus the other places where the communication package is a smaller piece, like AT&T, it's going to be a smaller piece in front. And so so it really, the challenge or the areas that I try to look at are places where this can be a large portion, if not a majority, of exposure to this, because I think this is where the growth in the telecommunications area is, and trying to find exposure to that growth in the public markets. I think it's a very, very challenging thing to do, because there's a lot of stuff going on in the private markets, but trying to find exposure in the public markets is a challenge at this point. So,
Absolutely. Well, that is going to round out our questions today. For all of you out in the audience, thank you so much for joining us, taking the time to sit down, watch this great presentation by Keith here. It's been an absolute pleasure to have all of you joining us as per usual. We will have a full copy of this presentation available here on YouTube. It will be going up on GuruFocus as well. If you did like the video, please do actually like the video here on YouTube. Comment your favorite part down below. It really helps spread things around on that YouTube algorithm. If you are new here, do please feel free to subscribe to the channel. You'll get access to all of our future content. You can watch all of our upcoming streams and things like that. Keith, it's been an absolute pleasure today. Thank you so much for coming out and joining us. We wish you and everybody out there in the audience the best.
thanks. Have a good day.